Well, good evening and welcome to this live stream on the 31st of December 2024. It's Martin North here from Digital Finance Analytics. Great to have you on tonight. And thanks for taking some time out of your New Year Eve preparations. And I suspect more people will be watching us on replay than normal because, of course, it's a busy evening. I used to live in Cremorne Point in Sydney and used to watch the fireworks every year from there. And for the first few years, it was pretty interesting. I have to say, I got a bit fed up with all the people towards the end of that and all the rubbish they left afterwards. But anyway, it was quite spectacular. So always enjoy watching the fireworks. Right. Well, the good news is that I have Damien here ready to come in. Just before I bring him in, let me remind you, as I always do, that we're not providing specific financial legal advice. This is a general conversation only. We do moderate the chat, but feel free to throw your questions and comments in. I've got some questions already there, so thanks for those. And there's plenty of time to ask more. This is right at the end of the year, the 31st of December 24, if you're watching in replay. And if you'd like to ask a question, if you use What the World, that gets into my queue, and that means I'm going to see it. And also, excuse me, and also, if you'd like to make a contribution to what we do around here, I've enabled Super Chat, or indeed get your question top of the list. We do this not for profit, but because we think there's a really important discussion to be had. But your support via Super Chat is absolutely appreciated, and it really makes a big difference to what we can do. So, with that done, let me bring Damien straight in. Damien, hello, welcome back.
Happy New Year, Martin.
Yeah, indeed. We're getting close, aren't we? You can smell 2025, as Phoenix said. We made it through 2024. What a year. I mean, all of the stupidity, all of the things that we saw, quite a lot of, things going on. And I guess I wanted to sort of get your thoughts on a couple of sort of immediate observations that I wanted to share. The first is just on this one. There was this wonderful meme showing how everybody is piling into the higher stock price, area, and almost nobody's looking at the lower stock prices, which I think was quite fascinating and tells you something about how the markets are behaving, possibly. So I'd be interested in your thoughts on that. But also, there was another quite interesting piece of analysis that I did, and I just wanted to share that because did you know that in fact the ASX financials in Australia outperformed the NASDAQ this last year? So the ASX financials in Australia has an annual return of 28.2%. The NASDAQ was 25.98%. In fact, the New Zealand 50 at 11.39% outperformed the ASX 200 and the FTSE in the UK. And the CAC 40 in France and the KOSPI lost value over the last year. And interestingly, over 3 years, returns on the ASX financials was 31.79% over 3 years, compared with the NASDAQ at 29.88%. So what do you make of that?
Yeah, look, for the Aussie financials are one. I'll put my hand up and say, look, I've got them wrong in terms of performance, but I can't marry them to financials and what's to the fundamentals. Sorry, and what's interesting, I've got a chart up. I just want to sort of highlight that, and this is one of these ones I do that I show both the rolling forecasts, which is the blue line on this one. So it's like the next 12 months of forecasts, and then they've got like all the individual the little ones of the individual years, but sort of trying not to let them take too much out of this, but. We've got here Commonwealth Bank, and you can see that the earnings, over the whatever it is, the last 5 years are sort of they've edged up. They're certainly up. They're not falling, but they're certainly not. They're basically where they were a few years ago, and largely flat. So it's all been the price that's done the work. So you can now buy Commonwealth Bank for roughly the same 2026 multiple as what you can buy NVIDIA for. And then you've got NVIDIA's numbers down there, and maybe the scale you can't quite see, but NVIDIA starts at 5 years ago at earning, I don't know, cents on the dollar, 10 cents a share or less than 10 cents a share, and now they're sort of earning $4.20 a share, and it's a bit of a rocket ship. On the way up, and then the numbers look like they keep rising. So So I guess I have a lot more comfort when I see a stock like Nvidia, where I can see the earnings coming through and the fundamentals matching. And I can say, okay, well, we might, the growth might go away, and I need to reassess and do a whole bunch of different things. But um, it's chalk and cheese in terms of the fundamental. You one stock whose earnings are basically going sideways and on one of the highest multiples we've seen, and both of them you can buy for roughly 26 times 2026 numbers.
Yeah, and it's interesting because Jonathan Mott, I think it's Baron J now, but he made the point that he doesn't understand the valuations of CBA. That they are, more rich than JP Morgan. The huge global bank. And as you say, if you look at Nvidia, you got to say, and in fact, Lucy threw this question in, which is quite good. So who are the investors? The Aussie earnings base has been decimated. So we seem to have lost most of the OECD countries, et cetera. So a lot of this, I guess, is going to be a superannuation in Australia. And I suspect also some mum and dad investors who are still with the CBA. But it does beg the question, doesn't it, about what proportion of the investor base in Australia are investing in Australian assets versus overseas assets. And generally, what you would say, I think, is that the US has been the market to be in this year, simply because of its superior performance and breadth of performance. So it's a fascinating question. Who's investing in CBA at these levels?
Yeah, and not even just the US though as well. It's the large cap US. So we have a global leaders fund which targets the sort of top 40 stocks globally, and that's up almost 45% over the last year. So, slightly, almost 46%. So it's a little bit over 45% at the moment. We've still got 12 hours to go. So,
it could change.
But, yeah, that's right. But that's that's one of our, and we have another fund that's a very broad based one, and that's up pretty close to 30%, which is basically in line with the broader global MSCI world, which has sort of got thousands and thousands of stocks, and it's up around about that 30% as well. But it just shows that very rarely do you ever get that small cohort of the largest stocks have such a massive difference, 15% difference in the performance versus the sort of broader index. It's almost unheard of, that type of that real concentration. But when you look at the earnings side of it, that's where all the earnings have been coming from as well. So when if you look at the Russell 2000 index, I don't know if you've got that on your list there.
Hang on, I can probably find that.
I feel like the returns for that are sort of for the year was, you've done about 11% on that, maybe 12 including dividends, and then you add in what the Aussie dollar's done. That probably brings you up to 20. But you're still miles behind most of those other indexes. And the Russell 2000 index is, it's all the stocks in the US from 1,000 to 3,000. So you're sort of cutting out the largest stocks and basically just sort of looking at what are the small cap stocks in the US doing, and that's much more similar, obviously, to the Australian performance. 11% in US dollar terms. And so while it's been a fantastic market in some places, it's not equally distributed. And as you spoke about some of those sectors, you got France on the way down, and whereas a concentrated one up, 45%. Then you can look at the energy sector. It had a terrible year, but the information technology sector had a great year. And so really, it was not this sort of rising tide lifting all boats. It was quite diverse and very much concentrated in those top companies.
Yeah, I've actually put up there the Russell just to sort of give comparison. So you can see here that the Russell's, just below 10%. So sitting there at 9.58%. And it showed, and of course, earlier in the year, the Russell was outperforming the the top end of the market in the US at one stage, right? That was before Trump and everything. So there's a lot of externalities here in terms of driving some of those things. And I would also say, of course, that when you look at the Nasdaq, if you look at the Nasdaq index, not all stocks in the Nasdaq are ahead over the last year, right?
No.
So there are quite a few that are actually up dramatically, and there are others that are actually not up at all. In fact, well down. So indices themselves can be a bit deceptive too.
Yeah, they talk about, often you hear about breadth, and the idea of breadth is, look, is it just everything going up, or is it only a select few? And this has very much been the case, that it's a select few that have really been pushing things in this case. Yeah, absolutely. And some of the other ones it's worth noting is it wasn't a good year for value. So the sectors that sort of went up, a mixture of momentum had a pretty reasonable year. So that basically means you're buying the stocks that are going up and selling the ones that are going down. So it's a simple strategy, but traders, basically, traders sort of who are just chasing the latest thing. Are they doing all right? And for the most part, momentum was a reasonable strategy. Growth was the strategy that worked really well. So basically, if you're looking for stocks that are growing, that was successful. Value wasn't a good strategy, which is that chart you had within there. But that's actually not dissimilar to a lot of years. Value is sort of this interesting thing, and it depends on how you like to define it. A lot of people look at, say, a Warren Buffett and say he's a value investor, and he is to some extent, but nowhere near as much as what value would be given, because what he's doing is he's matching off sort of a mixture of quality and growth versus value, and that's what we try and do as well. We're sort of someone who tries to say, well, you don't just buy the cheapest stocks. So let's say if you're buying a car, for example, you don't just say, well, look, I've got some Russian or North Korean manufactured car that I can buy for particularly cheap, but it just doesn't go. You're like, well, yeah, okay, I don't want to buy that. And at the other end, you can go, well, I can spend $1 million on some sort of supercar, and that's great, but the speed limits, I live in the city and the speed limits, 50 or 60 kilometers. Having a $1 million supercar isn't really going to give me value for money either. And then so you're sort of trying to match that off and say, well, where does that fit for the quality versus value trade-off? And if you can buy, say, a high-end BMW at the same price as you can buy a say a Chinese-made sedan, you might say, oh, I'll take the BMW if I can get it for the same price. But then you start going, well, okay, well, now if I've got to pay, $150,000 a year for that versus $20,000 a year, you're trying to make that trade-off as to where the quality and where the value is. And I think that's, to me, that's very similar in stocks. And so, it's not just about chasing value for no purpose. It's about saying, setting your line, your parameters up and then trying to trade those off. And that's where the Commonwealth Bank sort of comes back to, is going, well, it just seems weird in that, it's a high quality bank. It's actually very high quality for a bank. It makes lots more money than better returns than you'd see in a lot of other banks around the world. But then the question is, how are they going to grow that over time? And at the moment, it's pricing in the same growth as what you're seeing in Nvidia. And absent some sort of calamity out there, I'm willing to bet Nvidia's earnings are going to grow, the next 2 years at a faster rate than Commonwealth Bank's earnings are going to grow.
Well, of course, CBA benefits from it being one of the big four, and the big four are able to take much higher margins from their banking in Australia than pretty much anywhere around the world. In fact, the returns from banks in Australia, because of those high margins, even now, even though their margins are down a little bit, are still a lot higher. Interestingly, go on.
Just before we get off those as well, and the other thing for the Aussie banks, I think, is that's priced in there somewhat is hey, we went through this Royal Commission, which was pretty damning in terms of the all the things that came out of that, and we haven't done half the things we said we're going to do in terms of implementation, and the public pressure is off now, and so the banks can get back to doing what they're doing, and wait for the next crisis to pop up, and then make some apologies and go on again. And so I think there's certainly a view out there that the Australian banks are closer to the regulators over here than most other countries, and most other countries want their banks to actually provide capital to other areas of the economy, so other areas of the economy can grow, whereas Australian politicians seem to be happy for banks to make some of the largest profits.
Yeah, well, it comes back to what Lucy said about, who are the investors? Well, the fact is a lot of people are investing in the banks. Why? Because the banks are actually given the leg up by the government and government policy. And as the base of Australia narrows, the housing sector and the financial sector is bigger and bigger and bigger as a proportion of the total. Just on the NASDAQ, this is quite an interesting take. So this is actually some of the biggest. So Nvidia is right at the top there, 175%, I think, over the last year. And if you compare that with Netflix at 84%, and then Tesla and ARM Holdings, ARM, I'm not sure what that's there for the full year, but anyway, it's pretty big. Meta, Coinbase, Amazon, Alphabet, CrowdStrike. Interesting, CrowdStrike's up despite they wrecking the economy.
Yeah, exactly.
But then Apple, of course. But over on the other side, you've got PacWest, Bancorp, Intel. Intel, of course, fascinating to see the chip maker really struggling relative to some of its comparisons. Yeah. That's the AI problem.
So I'll admit I was Intel fell far enough. Probably must have been last year that I had a bit of a dabble in Intel, and then I gave up. Earlier on this year, with a view that actually it does look like it's endemic. That's sort of set in terms of Intel. Maybe at some stage they'll get some sort of turnaround, but I think they've missed the boat on so many different parts. It's and there's talk now. Recently the CEOs were fired, and now they're talking about whether they break the whole thing up. It's
fascinating when you think back, 20 odd years, how Cisco, then Intel, were ruling the roost, and then they. So the question is, will Nvidia go the same way? Interestingly, of course, if you look at the chips, you've got AMD there, who's also down, not quite as much. The Philly Semiconductor Index was positive, but not dramatically so, 20% relative to Nvidia over the year. And you've got a couple of other like Applied Materials and a couple of others there who are actually drifting around. So even within the whole AI realm, not all of the tech stocks are actually catching the drift the same way.
No, absolutely. And we do some breakdowns of indexes. So we've got so just to recap for anyone who hasn't listened to me before, we have this idea that you've got this nucleus of assets to sort of sit in the middle as your sort of core index, and then around that you sort of invest. You can invest around that, and we have lots of these things we call tilts, and we also have screens so you can sort of knock stuff in and take it out. And then when we run through and we say, what were the best screens you could have put on, or what are the best tilts you could have put on over the last year? Basically, the answer was, did it have NVIDIA in it or not? Because if it had NVIDIA in it, yes, it was that was the best screen you could have. And if it didn't have NVIDIA, then it was probably one of the poorer ones. But that one, look, that chart you had up there, to have a year where one of the largest stocks in the market had such a dramatic growth, is extremely rare, I guess, to have that. Usually it is a mixture of a whole bunch of stocks. Like I think you'll find that NVIDIA on its own, I can't remember the rough numbers. It'd be ballpark 5% of the performance. I would have thought that you've got. Just from that one stock. So when you looked at the S&P 500, don't quote me on this exact number, but if you looked at the performance for it, it would be a meaningful part of that overall is basically whether you owned NVIDIA or not.
And there was a chart I think that I saw the other day saying that if you strip out the 5 or 6 big tech stocks from the index, then it's actually much, much, much lower. I mean, it's absolutely distorted by those small number of very large cap stocks with very high valuations. And of course,
and having said that, the valuations are not that extreme. Like that sounds like So when let's use the tech boom as an example. So when you're going through this tech boom back in 2000, there was a lot of stocks trading on sort of 100 times price to earnings ratios or more. So you're basically saying if they're earning $1, they're valued at $100. And the average for the market is more like about 20, somewhere between 15 and 20 is probably lower. 17, so call it 17 is your longer term average. But quite often, it'll be at 20 times. And so all these ones are 100 times. Whereas most of these stocks we're talking about now are trading at sort of 27. Well, take Nvidia is trading at, I think, 33 times next year and 27 times or 26 times the year after. They're not sort of so far out of the realm of valuations that you look at them and say, oh, that looks crazy. Maybe Tesla might be one example of where you look at the valuation and it's very hard to, I think it's probably valued at twice every other car company on the planet put together. But X that, most of those have got valuations that are, reasonable given how much they've been growing and the growth that's forecast into the stock. And so, and I guess I just keep coming back to that. Nvidia as the example, while they're up 150% over the last year, just trying to draw roughly in my head, their earnings would be up 120%, maybe 130% as well in that same time. So as long as you're seeing the earnings, it's less concerning. And so it's it's more when the earnings stops. But I guess your point on that Intel was that these guys, they make their factories and they cost them whatever it is, $20 billion and to do it, and they're obsolete in 5 years, and you got to make the new factories, and so it's a high cost game. And if you're not still on that bleeding edge, nobody cares anymore. Nobody cares that Intel might have had the best processors 5 years ago. They're like, well, if they're not as good today, I'm not buying them. There's not the same brand loyalty. Whereas I think you find in other industries, you'll get a relatively long tail of brand loyalty that might last a decade or more, where people are like, I always buy XYZ because I buy this car because my last car was fine and all that type of stuff. And then if car companies start if they become unreliable and they start putting out lemons, most cars last for 10, 15 years. You're only affecting sort of a very small portion of your customer base. And so it takes a while for that to filter through. Whereas that's just not the case in semiconductors. It's a nasty industry. Yes.
And the technology shifts underneath them. And of course, there are other competitors who also create the dies and the chips. And it's a margin game, and the margin, of course, get compressed quite quickly. The R&D costs are dramatically high as well. So if you don't get the take up, you can't amortize the R&D across the base, and you end up chasing your own tail, basically.
Yeah, and sometimes it's a very small change, or sometimes it's something where a company makes a bet on something that everyone else thinks isn't going to work. And so whether it's ASML sort of made a bet on a technology that everyone else, all the Intels and that had basically said, no, this technology is not going to work. And then all of a sudden they got it to work and they grew into a massive chunk. But that was a very risky decision. That was I don't know if it's life or death for the company, but certainly the thing between them being a small cap stock and being a mega cap stock. Absolutely. So it happens all the time in that industry.
Let me just briefly switch across to the Australian share market just for comparison, because it's quite interesting. This is actually, and it's slightly deceptive insofar that not every label has shown because there are too many, but Nucleus is right at the top there with a return of 233% over the next year. That's Pro Medicus. So that's a medical stock, 161%. And then we've got Net Wealth Group, which is a wealth management entity.
Well, and a fintech.
And a fintech. As well. And then McGrath, the real estate chain. And then you've got Altium. And then AMP. Now, of course, AMP had a massive bath a few years ago, so they're sort of clawing back. It's quite interesting. Aristocrat, which is one I've been looking at for many, many years, are still churning out the cash. So you can see there that there's quite a mix at the top of the index, different industry sectors.
Yeah, but I'd also say they're largely, or those ones at least, are largely tech stocks in terms of that, in some way or form.
WiseTech certainly is, yeah.
Yeah, but even Aristocrat is software and gaming and things like software. Yeah, gaming. Technology and also software for gaming, actual games for internet games. The other one was I was going to say the other thing you notice on that is they're not big names.
No,
in terms of your largest BHPs and Rios and CSLs and that's the difference, I think, in terms of the performance for the ASX. If Nuix, if that had been CSL instead that had done that, then you'd be talking about the ASX being up whatever it was, 15 from might be up 20% if you're sort of looking at something like that.
Yeah, absolutely. Yeah, and just down at the other end, again, not every label is here, but at the bottom you've got Bowen Coking Coal, Liontown Resources, Afterpay Touch, which is a fintech, interestingly, Mineral Resources, Domino's Pizzas, Collins Food, Fortescue Metals, Beta Share, US Equity, Strong Bear, Currency Hedge. So that was one that didn't quite go the right way. Yellow Brick Road, Nanosonics, Champion Iron Ore, BHP, Woodside, Ingham's, Whitehaven Coal, Helios, Sonic, Rio, Santos, Australian Financial Group, CSL, and so it goes on. So, some of those are actually, in quite deep negative territory. And certainly the one down the bottom there is Bowen Coking Coal, which may have something to do with the, the evolution of the energy industry.
Yeah, well, look, I think there's, and that's part of one of our factors for 2025 is saying, is what the energy markets are doing, or particularly the gas producers in Australia, is that going to be enough to create some sort of crisis in Australia? Now, I'm not as convinced that we've got time to do it in 2025, but it's certainly a possibility. And so if you want to take a sort of a bear side to it, and I guess I want to say within this, our overall view on equities is we've been pretty fully invested in equities. Effectively our super type product is sort of up around 15% for the year, 15, 16%, I think, once we see the final numbers from markets and everything like that. And whereas the median super fund, I think they were talking about today being sort of about 11.5%. So, and that's because we've taken a big punt on international. So we're sort of quite negative on Australia, but at the same time, we're not sort of negative on equities everywhere. And so I think there's I guess where I'm leading with that is we've got some concerns about the Australian market, but we're still look at this as saying if there's pullbacks in global markets, we're still going to be looking to be buying unless we see the fundamentals change, because that's really where I guess we're seeing that as long as earnings can keep rising and it might there's a reasonable case. There's really a bull case that effectively markets are just looking forward a bit further and saying, well, tax cuts, much less regulation in the US. There's a trade war and tariffs, but actually maybe that's enough to, there's enough momentum in the economy to get through that. And so that's sort of our bull case. The bear case and the concern for Australia is you've got this energy cartel effectively doing whatever they want in terms of pricing wise in Australia, and it looks as if both sides of politics aren't going to go there in terms of making it a major issue. And then we've got the RBA looking at it saying, hey, energy prices are way too high, and that's what's sort of driving inflation, and so we can't cut rates until we start seeing that come down. And the net effect is you could end up in this situation where we have the Australian economy really weak and interest rates too high, but the RBA sort of painting itself into this corner saying, no, until we see energy prices fall. And as the Aussie dollar falls, those energy prices keep going up. So even if energy prices globally stay where they are, we've already had the Aussie dollar come off, 5-10%, not 10 quite yet, but 5%. You take off another 5%, and now you've got energy prices that much higher. And so so I guess what we're sort of painting the picture of saying, well, there's this risk that Australia really does run into this problem that we've sort of been avoiding for years and years and years in terms of if you just sort of you allow, I guess, the rest of the world to sort of determine our policy for us and hope you get lucky, and that's sort of that's worked out for a while, but this might be the year that it actually all comes unstuck.
Yeah, and just on the Aussie dollar, let's put that up. So it's at 62.17 at the moment. You can see it's been drifting down, and it's dropped quite significantly. It's continued to fall post.
So it is 10.
Trump.
Yeah.
So that's a significant factor. Now, of course, that has positives and negatives. It might mean that we get more tourists coming to Australia because it's cheaper for them. Well, on the other hand, it's more difficult the other way around, and has a significant impact with regards to imports and exports.
Yeah, and so and that's this. I guess for the RBA, they seem to be a little bit more hung up on energy prices and I guess a little bit more positive on wages than I would have thought. So I've actually got a chart up just showing, it's sort of, I guess it's a comparison, just showing that where we were a year ago and what the rate projections were. So the grey lines for each of these markets, the US is the grey line is what was projected at the start, and then the blue line is what interest rates actually did. And so you can see, all these countries that have started cutting. Canada is basically the only one that ended up further down than what they're expected to. Australia's not on this chart, but we haven't started cutting. So, to any meaningful extent relative to others. And so, there's sort of that interesting question about is this because the RBA is more farsighted and understands the situation better, or is it that they're hung up on measures that might not be the right ones, I guess is where I'm getting to. And I think it's probably the latter. And if they've been talking about these issues around, you're talking about wage growth as if it has been a constraining factor, but in my mind, wage growth is just not high enough to be really contributing to inflation, and it's far lower in Australia than what we're seeing elsewhere. And then the energy prices that they're basically going to look through the policies that we've put on to bring energy prices down. Whereas I guess what I'm saying is, well, that makes sense that politicians aren't going to suddenly jump them up, and so we should be dealing with the hand we've got, not the one we think we would have had if we didn't have fiscal policy.
But that's an interesting observation, because what it suggests is that if the RBA continues to look through the temporary support for energy prices, in other words, the headline inflation is lower relative to the underlying because of that. If that goes on, then is the RBA going to continue that? Because if it does, it's going to actually keep those interest rates quite a lot higher. Interestingly, around the world, there have been almost 200 rate cuts from central banks since the peak. Of course, zero in Australia. And there's a big question in my mind about the impact of that, because, of course, rates are, 4.35%, not as high as some other places, but still quite high. And maybe not much downside opportunity to cut rates. And that's an interesting observation, I think.
Yeah. So the question is, if you saw another 5-10% come off the Aussie dollar, then energy prices another 5%, 10% higher in Australian dollar terms. And so, I don't know. I can't say I understand their logic. Like, it sort of feels as if, to me, they've decided not to cut. And they might lose the opportunity, and they might paint themselves into a corner where falling Aussie dollar is basically keeping inflation a little bit higher than, because imported goods then get a little bit higher, and so you sort of end up in that in an unenviable spot in terms of that. But that's also sort of comes back to some of that stuff we were talking about around productivity as well.
Yes,
this is a good time to.
Oh, but good to get into that. And of course, I think whether you saw John Kehoe's latest in the AFR, it was there a couple of days ago, again, throwing rocks at the lack of productivity growth, the fact that 20 years of bad policy is now coming home to roost, and basically posing the question, is 2025 going to be the year when effectively we finally go off the rails?
Yeah, well, so I wanted to dig a little bit into this productivity. So I've got the chart up just showing where Australia's sitting at the bottom of the league table. That's over a year, but you can do it over multiple periods, because there's a couple of countries, I think Japan, for example, if you do it over 3 or 5 years, they actually look a lot better. So so 1 year is not always the right measure, but in this case, you're getting the same answer doing it 1 year or doing it by longer periods. As Australia sitting right down the end. And so some of the factors that's worth just sort of thinking about when you go into this is that if you look at public demand, and this sort of factors in, this is a chart from Westpac, but it factors in a few other things as well, like where governments are buying services and goods, as well as sort of direct government spending. But we're at sort of this record high, and it's just been this rocket ship for the last 8 years or so, 8 to 10 years, of where we're sitting at this massive amount of public spending. And then when you dig in and say, okay, well, what is that? What does productivity look like if you sort of broke it out between the non-market sector, which is effectively governments, and the market sector? Is you go, well, the market sector has actually been pretty good in terms of productivity. It has, hasn't been perfect, but way better than what we're seeing in the non-market sector, where and so effectively it's this mix of saying we're getting more and more of the sector that's the least productive, that's sort of making up the Australian economy. And then we jump into some of these charts. We've shown a few times on here. This is all from Jared Minak, puts out a few of these ones, but just showing that if you look over the last 70 or 80 years, the net investment sort of percentage of GDP you used to see in Australia was sort of 10%, and it's broken up, these two lines. The red one's the total line, and the blue line's the ex mining line. And so then you sort of look and you just go that ex mining line for the last 20 years has just been plummeting, and our average for the last decade is sort of more a little bit over 5% in terms of what we're spending. Roughly half what we used to spend. Now that's just as a percentage of GDP. When you then start looking further at that and then saying, well, what about if we've been running this record immigration level? So if you actually look at the capital stock you have per person, we're actually back into negative territory in the last couple of years. So we're actually seeing we've actually got less capital than what we used to have, and that sort of that sort of, when you look at it with that lens, you're like, well, sure, that makes perfect sense where we've got a productivity problem. If you've got less and less capital per person and you're just relying on bringing in, I guess, uni students and cheap capital to keep your wages bill down, that's where you run into this problem, and that's why you have these productivity issues. Because if you've got an issue where somebody's like, well, I've got a problem, and this is where we saw this. Actually, sorry, I should take one step back. Where you saw some big productivity increases during this COVID period, particularly in the US, was this part where people went, okay, actually, we've got this big demand shock. We need to let go of a bunch of workers, so we let go of a lot of our least productive workers, and all of a sudden productivity shot up. And then it was this idea about, okay, we've actually now got less people, but we've got all these new tools and ways people can work from home. And actually, there's different things we can do. And in other countries, they're talking about a bit of a productivity boom, particularly the US, in terms of saying, well, a lot of this is coming because we didn't have enough workers, and so we needed to find new ways to do things. In Australia, we've had the opposite problem, where we've actually for the last couple of years, where we're going, well, we've got all these extra workers. I could think up a smarter way to do this, or I can just throw more cheap cheap new immigrants or cheap students, new graduates at the problem, and I'll end up with the same result. And so it's that part about saying, it's incentives matter. If you don't, if you give companies access to cheap workers, and keep wages low, then they will absolutely use cheap workers and the cheap wages. If they have to keep paying people more, then they'll find other smarter ways to do things. And I think that's where we're left for Australia, is that the productivity is a factor of the policy decisions we're making.
Yeah, and of course, high migration, a lot of people coming into the country. A lot of those people coming into the country going into some of those sectors, healthcare, for example, and ancillary sectors. And I'm not saying those aren't important sectors, but in terms of actually creating a greater economic pie, it's hard to see where that productivity growth comes from. Whereas, in fact, the high productivity growth sectors like manufacturing, potentially, and where you can be really efficient, or some other sectors are disappearing. In fact, the economic base of Australia is narrower now than it's ever been, if you look back in history, which is amazing to see. And we're right down in the hundreds now in terms of relative to many other economies around the world with a broader base to their economy. So
yeah, and I have lots of I just want to say as well, like, I think a lot of this sort of comes back to the NDIS and what we've seen in terms of costs explosion there. Now, I've got lots of sympathy for the NDIS. I think it's a great thing. I've got a child who's autistic and nonverbal, and he's 18 and doesn't talk. So I certainly see this, but I also see the profiteering that goes on in that sector, and the idea with a lot of because there's these big bucks available, the view of a lot of, it appears to me that a lot of the providers are just basically going, well, I can charge whatever I want, and the people who are getting the services shouldn't care because it's coming from the government anyway, and so therefore I can just keep charging higher and higher rates. And I think I think we certainly have a problem within that, and there's that's part of the issues that we're seeing within this. And I think there's some issues that within this whole push-pull in Australia, which is why we're seeing this massive amount in this massive growth in those in the amount of public spending, which is this idea that there's things that markets are very good at doing, and you need to have competition. And Australia has done a fantastic job in, say, the medical sector at actually doing that and creating a medical sector that in terms of dollars for medical outcomes, Australia is right up the top in terms of what they managed to do in terms of creating a relatively competitive sector. But it looks like we're doing we're all the lessons we learned from that, we're not applying to the NDIS. And we're just sort of allowing a sort of open slather, and companies are much more efficient at governments at doing a lot of these things. But the issue right now is, I think personally, I think they're much more efficient, but they're taking all those gains themselves, and they're very efficient at extracting money from governments and charging too much. And there's there's this problem about, we need constraints on this, and we need better regulation for a lot of the factors, and all the same factors that we speak about, the problems for the banks and being too close to regulators and not having enough oversight and not enough competition is exactly coming through in some of those areas, which is why I think we're seeing that there's productivity issues for a lot of those.
And I suppose the other context here is what's happening in China. And, the question of the Trump tariffs, the slowing economy in China, the amount of stimulus they're throwing at the economy in China, and how that flows then into the exports and imports into Australia. The theory, I suppose, goes that if in fact Trump's put tariffs on, we might get cheaper stuff coming from China into Australia. On the other hand, It might be that they're more constrained and have less demand for our resources, which could be a negative break on what's going on. So that externality seems to be the other big factor in all of this. So you've got this local productivity problem, which is everyone knows about, but you've got this international context, which again potentially has some negative impacts too.
Yeah, so Australia's got one of the lowest, well, I think, sorry, not one of the lowest, the lowest manufacturing share of economy in the OECD. So we import most of our manufacturing, and that's sort of well, energy is one part of that, but there's also policy decisions. You know, we've sort of ended up in that spot. The issue, so as China gets as China sees these tariffs come on, and the question about how high they will be and all those types of things is that's still, you know, if Trump does what he says he's going to do, exactly what he says he's going to do, it's going to be quite devastating for the Chinese economy. There's a strong possibility it gets negotiated back at some point, but does it come back to something much lower, or is it just a little bit lower? Um, who knows? I think we're working, I think, on, and I think it's probably, I'd say financial markets are pricing it in as it's probably going to be relatively high. You know, maybe it won't be the 60% or whatever, but it's going to be high enough to make a meaningful difference to Chinese exports. The most likely scenario is China will devalue its currency, particularly against the US dollar, but that probably means devaluing against the Australian currency as well. And it means they're going to try and export to other markets as much as they can. And so that probably means a wave of sort of deflationary goods coming from China into Australia. And one of the areas, as you said, that, you know, one of the areas I do think is going to be most affected is this iron ore price. And I've just got a chart up of I don't know, 100 and something years, 120, 130 years of real iron ore prices. So it is adjusted for inflation. And so we're sort of around about the $100 level at the moment. And I've got these sort of 2 time series going back, and you can see that, you know, $30 to $50 is sort of the more typical range for this for the iron ore price. And look, most companies at $50 US are still making money on their own iron ore and still making sort of returns on it. And iron ore is it is a metal that's very widely distributed around the world. And so the question is, you know, have we become used to these prices as the Chinese property boom went through, of having $100 to $200 iron ore prices, and now we think that's the normal price, or will we revert back to those lower prices? And in my view, we're reverting back to those lower prices, and I do think 2025 will be one of the years where we see some meaningful regression back to that sort of $50 sort of long-term price. And part of the reason, part of the evidence I think I put out there is that the number of new projects that are coming on is still really high. So commodity companies and resource companies still look at this metal and say, look, if the price is $100, you know, I'm willing to do heaps of different projects to bring it on. And so you will see, there's an interesting article out the other day in the AFR with somebody who was, you know, saying Simandou is not going to be the Pilbara killer because it's only bringing on 75 million tons, and we're actually going to bring on way more than that in Australia. Plus, Brazil's going to bring on all this extra stuff. And it's like, well, just a minute, that's not saying that. We've got this big new source of iron ore, but it's not going to be a big issue because we've also got massive expansions in Australia and Brazil is just sort of showing that those expansions are going to keep going until the price does come down to a more reasonable level, and that's going to hit the Australian budget pretty hard because and we're already seeing coal prices and everything come off. And so, we're still doing lots of exports of LNG, but actually we hardly charge any royalties and any tax on that anyway. And so, our real benefits come from iron ore and coal, and there is a strong probability, in my view, that we see further deterioration in those prices. And
And MyEFO's forecasts were for lower iron ore prices. Now, they've forecast those in the past and they haven't come to fruition, and that's created a bit of a hollow log for them. But if, in fact, their estimates are closer to the mark this time, then the income generated to Australia from those iron ore exports looks to fall.
Yeah, and that was, it was one of those they talk about Australia being the lucky country, and the last time China had a big slowdown in 2015 coincided with a whole bunch of dam disasters in Brazil, which took off most of them. One of our major competitors, iron ore, and kept the price high, and so not saying that exact same thing went, but maybe something else will happen, and we'll get lucky again, but. I think the default needs to be that this one of these key drivers of the Australian budget is going to be coming off quite substantially this in 2025.
Okay. Well, let's move on and there's a couple of questions in the chat which I wouldn't mind just teasing out. And this one from Joshua early on. Just had a baby, opened a high growth investment account with Vanguard. If we invest $200 a month, should that be enough for a deposit in a house by the time she's 30? And I guess there's a couple of interesting questions there. The investment vehicle, but also the relative returns of property versus, financial markets. So a lot to get your teeth into there, Damien. What do you think?
Yeah, sorry, let me just do the math. I should have done the maths beforehand. 200 by 12 by 30 is 72,000. So you should have enough deposit by then. Look, there's a couple of things that I want to say so one is children's investment accounts. so let me do the financial planning side of this as first. Children's investment accounts, you probably want to have that in if you have a partner, whichever partner you think is going to have the lower income consistently over the child until they're 18, is probably the right way to go. I've got an article up I did a while ago, just sort of showing what the different tax rates are and where it all works out. But yeah, you want to have a separate account in say your partner's, whichever the lower earning partner's name is, in their name as trustee for the child, and you want to keep that really separate. So you basically want to make sure that you can add more money to it, but you want to make sure that if it's paying dividends, the dividends are being reinvested or they're being added in. So we run some children's investment accounts for exactly this reason, where it's separated out, and that's because what you want to make sure is when your child turns whatever 18 or 25 or whatever time you transfer the shares to them, is that you don't have to pay capital gains when you transfer it. At some point, you'll have to pay capital gains. You have to pay capital gains when you sell it. But if there's any ambiguity or money's sort of been coming, especially money coming out of that account, or there's been sort of co-mixing of assets and things like that, then you might find that you got a big capital gains bill when you transfer the shares to your child. The other one is so that's one financial planning part. The other part is there is a first home buyer savings scheme, and which runs through your super. And so this is for when your child's turned 18 or started work, I guess, and wanting to keep saving. And the real benefit there is it effectively uses your tax rate from your superannuation account to save. And so let me use $100 just to make the maths a bit easier. But if you're putting away $100, well, actually, sorry, no, I'll use this case, $200. So let's actually say let's say you've got somebody who's on sort of $100,000 to $150,000 type salary, and they're wanting to save $300 of pre-tax salary per month. So you get your $300, you pay your tax on that, and you've got $200 left, and you stick that in your account. Whereas if you did it through your super, so because you're being taxed at sort of 30-odd%, if instead you did it through your super, you're only getting taxed at 15%. So you start with, actually, I will use $100 just because I keep using that one easily. So you go $100, you start with $100 pre-tax, you invest $70 post-tax, or you can start with $100 pre-tax and you're investing 85. And so you're getting a 20% pickup in performance on day one just from the tax savings. And then you get the compounding effect. So so you want to have that using a super account. Anyone who wants to do these, more than happy, book yourself in a call. Tell us you're from the Walk the World, and we can set up these types of accounts, but lots of other people can as well. But the key thing is make sure you get it. You're doing those two things. While the child is under 18, you're getting it right, And while the child was, once they're over 18, you're doing it through a super, because both of those will make it much more tax effective and get you a lot closer. You could end up, as I said, you can be 20% up, on a tax basis on day one. So that'll certainly help you in terms of those. What was the other factors? And then now in terms of returns, in terms of markets. So, global leaders up 46% is not a typical year. I think you should be factoring 6 to 9%, I think is the right so pick the middle of that range. 7.5% is a reasonable expectation for stock markets from a year-to-year basis. Now, where does that come from? Well, I think that's the most important thing you need to consider with these, is that that tends to come from dividends of 3 to 5% you get out of dividends, and then you get earnings growth on top of that. And so if earnings growth is another 5%, and this is the types of numbers you get, over a longer term, and that 5%, actually, I'll break it down one step even further. You're getting, say, 3 or 4% dividend yield. You're getting 2% inflation and 3% real growth, and that sort of ends up, that types of return. So that's why you're getting that return over a longer term time period. Within property, then it's a different issue within property. If you're the big picture view is you have a depreciating asset, which is your actual house sitting on top of an appreciating asset, which is the land value. And if you have the same regulatory situation that we do at the moment, and you keep trying to constrain land, then you could see some pretty good, decent growth in those land values. But don't discount the fact that property, the actual property itself, there's some big costs to it that often get hidden behind a lot of this. You see people who talk about saying, yeah, I bought this house for 600,000, I sold it for 800,000, and I made myself this, notionally it looks like you made yourself this $200,000 profit. And then you take off all the stamp duties and agent fees and all that type of stuff. And then the fact that you did $100,000 worth of renos, or, new kitchens or carpets or all these other factors, and actually it ends up being zero. And the interest you've paid and things like that. And so often the house price indexes will just capture that 600,000 to 800,000. That's a 25% increase. Happy days. Whereas they might be missing all those other costs that were embedded within that. And so, I think at least when you look at a stock market index, it's not like, oh, I've missed, when you see it's up 10%, I know it is up, pretty close to 10%. There's a bit of tax issues either way, but that's largely the return. There's no actual extra hiddens. When you see a property index up 10%, you're like, I don't know, is it really up 10%? Is it not? Is it down? But you've got, change in composition. Have you factored in all these other things? So, yeah.
And this is interesting. If you look at some of the longer term comparison tables between stock market investments, investing in gold, investing in property, et cetera, they actually come out relatively close over the long term, but actually market investments tend to be slightly higher. And I suspect that's because the cost of carrying gold and the cost of maintaining the property aren't actually fully factored in the normal headline numbers. And once you take the account of those, you need to fix your roof every now and again. I had to have mine fixed the other week, right? Because I had a chunk of tree come through. So all of those things, need to be sort of factored in too. I also think the other point, Damien, is we've had a significant run up in property prices thanks to policy over the last 20 to 30 years, high migration, the deregulation of the financial system, negative gearing, other tax breaks, all of those things. And as a result of that, property prices have accelerated in terms of growth quite a lot higher than the longer term trends as well. So the question is, are we going to get the same amount of acceleration in property prices over the next 20 to 30 years? And if we did, that would put housing affordability from the impossible to stupid, in my view. So I suspect that we're not going to find that, because there's a finite limit on what proportion of an income people can actually afford to pay to be able to actually buy a property.
Yeah. And if you talk about some of the really long-term stuff, I've seen ones that talk about the median prices. Median prices have increased, from whatever, over 100 years, they've increased by 10% per annum or something like that. And you go, yeah, but 100 years ago, I was getting a 2-bedroom miners cottage, whatever, in an inner city suburb, and now I've got a 4-bedroom McMansion.
Yeah,
how did that happen? Like, what magically went? I got a 10% return. It just all of a sudden, I turned one house into another house. It was like, no, somebody had to knock it down and spend money and build it, and that's never captured in, or not. Not captured in a lot of those indexes.
Absolutely. Now, there's another question that's come in the chat, and it's one that's sort of adjacent to some of the things that you want to talk about generally, and that's to do with the Bitcoin ETF situation, because of course 2024 was the year that we found spot Bitcoin ETFs really started to take off, and we've had quite a lot of investment flowing in. And in fact, we had a series of questions. Let me just put this one up. This is from Down Under Drover. ETFs are becoming what's happening now. We had the early miners and whales. Are they selling or are they buying? And to what extent has there been a pump and dump because of the ETFs? And more importantly, to my mind, and this is the thing that I think people may not understand, I don't think necessarily some of these ETFs have to hold Bitcoin themselves. They can do it synthetically as well in some cases. So does that change the story of Bitcoin? And Phoenix actually then threw the question, were you going to add Bitcoin into your portfolios for clients? And then Down Under came back and said, is Bitcoin and its ETF mainstream adoption rather than the crypto wallet holders? And that's the question, is Bitcoin out there, outlanguished now? Is it mainstream? And just for those who've not caught up, the latest Bitcoin price is sitting there at around at 94,000. So went over the 100,000. We've come back. So there's a few interesting threads there, and your choice as to what extent you want to touch them.
Let me start with what I'm doing on it. Am I adding it into any of our default portfolios? No, I'm not. I don't think it's not a core asset. It's an asset that so it's that idea that I've got these core assets that are low volatility, pretty high quality, blue chip international, blue chip Australia, government bonds. That's your core, and then around that you can do the more interesting, wacky things. Now we are looking at all the regulatory issues around, and they're not insignificant, certainly from the way we manage it. I think if you're coming from this from a product provider perspective, which is, hey, somebody wants to buy this, let's just let them do it. It's much easier than when you come to it from a how we're approaching it from we're trying to put people into what we think the right portfolios are for them and risk adjusted. But we are looking at how we can do it as a tilt, so people can say, yes, I just want to have that Bitcoin, and just so I've got all my investments in one place. And we think we've got the costs right down low enough and all that type of stuff. So yes, we're working on that. The interesting part of this is, which I think sort of lost, the irony is not lost on me anyway, is that one of the key things we really needed for Bitcoin, which is this alternative payment system, is to be able to buy it using the existing payment system. And so in the investment system, it's like, just a minute, Bitcoin's meant to be this wonder thing that you just you can just buy it yourself and get rid of all these transaction costs and management fees. And it's like, well, no, but what I really need is an ETF with a management fee and a trading cost. And then it's really going to take off. And so anyway, sorry, where was the other question going with that? Was the pump and dump side. Look, so I mean, look, I don't know. I mean, I think that Donald Trump is financially incentivized for cryptocurrencies to go well, and some of his things that he's involved in to go well. So he'll do what he can to help them out. Does that mean that he would be happy for 100 different cryptocurrencies that he wasn't invested in to all tank, and the ones that he is invested in or he has got something in to boom? Absolutely, I think he'd like that to be the case. Would he care if, or is he happy just for the rising tide to lift all boats? Maybe as long as his ones do well. So it's sort of a bit. There's some idiosyncratic things within that. My longer term view on these is that it's private money, and that governments don't really like citizens to have private money, and they'll do what they can to. And Bitcoin doesn't have an army at the moment. If you lose your Bitcoin, it's very hard to. It's much harder to then turn around to a government and say, "Hey, there's this private money that I had that you guys have no say over. Can you come in and protect it for me? Can you come and protect the value for me and make sure that I get my money back?" Whereas you're like saying, "Well, it's private money; it's yours." If you wanted us to protect the money, put it in one of our banks and put it with our currencies. So I do think over the longer term, that's the case. Could you? I think you need to be able to look at these and say that is that coming back to that irony statement I was saying, is that you need to be able to look at them and say people can put these into their portfolio without having to go through the existing financing system. Then it's actually proof that it's successful. But at the moment, it's not. It's almost proof that it's not working, that you have to buy it through an ETF.
Well, it's almost that it's become mainstream and it's become playing now the financial system game, just like other financial assets. So in a way, the very essence of what Bitcoin was attempting to be, which is to be outside the financial system, has proved to be not necessarily where it's ended up, or at least where it currently is. Where it goes next, of course, is an interesting question. Actually, I've got a Bitcoin pundit on next week, Adam Stokes, to chat about where Bitcoin might be going. But today, the point I would make is that you're right. If you want to actually do this, you've got to play within the financial system to get access to the Bitcoin via the ETF. So,
so you don't have to, but that's what's been driving this.
Yeah, well, that's right. And guess what? They clip the tickets on the way through, right?
Yeah, absolutely.
And that's the thing people need to understand about ETFs generally, is that financial players make money through those transactions.
Yes. Oh, and actually, well, the Bitcoin, there's two parts to this. There's the trading costs of when you're buying in or out. But if you're in a Bitcoin ETF, there is a fee that comes out, every month, and so that's that's just part of the. But in a way, that's insurance. So the fees sort of be, I feel like maybe 0.2 to 0.4 is sort of like maybe 0.2 to 0.5%. Yeah, is sort of the typical range of that. So it's not terrible, and it's a bit of insurance, I suppose, that you don't lose your key in your wallet and all that type of stuff. Is saying, well, somebody else is managing it for me, and is it going to get stolen? Well, hopefully Vanguard or State Street or whoever's running the ETF doesn't have it all stolen, or at least has enough insurance that they're covered for that stuff. So from that perspective, maybe it's a small enough cost to pay, but let's keep coming back to, well, just a minute. Why am I buying it if I don't think it's going to work? In which case you're saying, well, I'm buying it really because I think other people want to buy it. And that's effectively, I think the way it's being looked at now is just a high beta version of the market. So when the market's rising, as we've seen over the last couple of months since Trump was elected, then it's going to rise by more. And when the market falls, it's most likely going to fall by more.
And that's an interesting context for thinking about, the idea of Bitcoin becoming one of the assets underpinning the US economy, right? So there are people arguing that maybe some of the US assets should be in Bitcoin rather than not. And Peter Schiff the other week saying, "You've got to be kidding! You're going to be putting, a cornerstone of the US economy into Bitcoin? Well, it could go up, but it could go down."
Exactly. Let's sell some US gold and put it into the Bitcoin. Put it in Bitcoin. Well, and I think though, if Trump had all his way, he'd certainly be. There'd be a Trump coin that he'd be advocating that X% of US assets get held in that. But
and as Phoenix says, there's no fees for self-custody, but we're not talking about self-custody here. We're talking about ETFs, right? And by definition, somebody else is looking after it for you. So interesting, isn't it? Okay, well, we're coming towards the end of the show, but I just wanted to get your sort of take on 2025. So I think we've already concluded this is going to be a relatively uncertain year. We've got the new Trump environment. We've got questions about the Australian economy coming out. We've got some questions about China. Obviously, there are conflicts that are going on in the Middle East and in and around Ukraine at the moment, which is another concern too. So as always, and I know you said this several times, you've got to think about what might happen, but also what might not happen, but if it did happen, what you would do. So how are you thinking about this in terms of laying the foundations for 2025. And is there anything going to change from 2024, or is it same old, same old?
There's a lot more uncertainty coming into 2025 than what we saw in 2024. So we knew sort of roughly what the policy positions were for most of the governments. We knew most central banks were looking to cut interest rates, and then you're looking for your and so we're looking for this. How fast does inflation come off? And sort of came off. I think maybe not as fast as people hoped, but faster than people feared. I think so. Sort of middle of the range was sort of where we saw that. The big issue for me into 2025 that we haven't really spoken about yet is inflation.
Yeah.
Now, the latest numbers we've seen out of the US, there's some signs of life in inflation ticking away. It's not out of control, but it's certainly enough there that and we even saw the Fed come out and talk about it, last week a little bit about, that inflation series is a little bit stickier than what they thought. Now, on top of that, we are seeing some clear front running of the Trump tariffs, and that's we've only just got we only knew, he was in a month and a half ago or a little bit more, and most orders take a little bit longer to come out. And then until we see those orders reported in terms of the data, that'll take another month or two as well. So it is quite possible we're going to see a couple of months of pretty strong economic growth in particularly in the US, where if you've got parts from China that are going to get a 60% tariff, or you're already going to get a 60% tariff, then you want to be buying a lot more of them now before. And so there's this thought around, are we going to see a bit of life in inflation? Are we going to see quite a strong US economy, all sort of brought forward? And then what does it look like once the tariffs come on, and how do we see that playing out? So so that, I think that's our key sort of factor now is watching those. We're keeping ourselves very much invested in international assets, and lots of stocks and not very many bonds, and not much in the way of bonds and cash. But we're then looking for those that turning point. Is that a big enough turning point for to start seeing markets fall? Because the fundamentals, very much still look really good in Australia. And while we ran through all that productivity stuff and there was gnashing about why is productivity so bad in Australia, in the US they're having the opposite. They're sort of talking about, well, why is productivity so good? What are the factors that are doing it? And I do think there's a number of industrial policies that Biden put in that were quite good in terms of Inflation Reduction Acts, and they will be. There's lots of growth that'll come through from that, and that'll tail into the Trump's whatever Trump policies Trump puts on are going to take a year or more to filter through to the economy. So the first little while we're just basically going to be seeing that same economy. So so this turning point about when the tariffs come on, do we see a drop off in growth is key for us. Trying to work out whether that means what do central banks do? Are they looking through that, or are they basically saying, no, the economy is growing great, let's hold rates higher than what we might have otherwise done? And then Australia, we're very much looking to try and work out, look, is it all coming to an end yet, or maybe it's late in the year that we're actually starting to see some of these factors really start to hit the Australian economy, and maybe it's more of a 2026 story. But there certainly are these risks to keeping rates higher for too long under an economy which is actually might seem like it's all right at the headline level, but actually has got some real productivity problems and some real per capita problems within that. You're basically looking at Australian economy that's in a private sector recession, where the private sector is doing worse than they were, and in a per capita recession, but it's being kept alive by more money spent in the public sector and more money and more people brought in, and that's not a sustainable recipe for economic policy. So does it come unstuck this year? Maybe. We're certainly keeping an eye on it and think it might, but seems more like a late 2025 and into 2026 story. So the timing of those are the key things for us. And the third thing that we're very focused on is company earnings. They're being pretty good, and If they turn, that's where we'll start getting wanting to lighten up on our stock market positions because markets are expensive. But if you look at markets now and they're at the sort of 90th percentile, say 90th to 95th percentile in terms of how expensive they are, so very expensive. But if you then add on some Trump tax cuts and easing in regulations and some extra profitability you typically get from those types of factors. So you add another, say, 10% for tax cuts and a little bit more for these other gains. Is that you can get back? It brings the market back to the 70th to 75th percentile of expensiveness, and at that level, it's like, well, we've got an economy that's slowing. Rate cuts are still factoring in. Growth's still pretty good. Would I pay the 75th percentile for an economy in that state? Yeah, I probably would. You've got to pay it. You pay that much in good times, and then when you're starting to hit bad times, you want to be winding it back. And so, but that's the way we're treating it. Is we really do want to see those signs of fundamental downturns before we start abandoning markets. Having said that, there's quite possibly a pullback at some point. We've had a great run up into the new year. Wouldn't be surprised to see a 5, maybe even 10% pullback in markets, just to bring some of the heat out.
And just a quick thought: Europe, of course, seems to be struggling more than Australia at the moment. We've got political uncertainty in France. We've got political instability in Germany. We've got the ECB cutting rates faster than almost everywhere else at the moment, trying to stop the economy falling over. And the manufacturing sector in those countries potentially are going to be exposed to the tariffs as well. So it doesn't look to me as though...
I'll add a few more on top of that. Is one of the biggest employers in the whole of Europe is the car sector, which is being outcompeted by China.
Yep.
And then if tariffs come onto China and China devalues its currency even more, and they don't put as many tariffs in Europe on China, then there's lots of other things that could go wrong there. So
and so Europe doesn't look like a particularly attractive sector of the market. We've touched on China already. So presumably from an asset allocation perspective, the US is still the best dirty shirt.
But in terms of large cap companies, when you look at large cap companies on a global basis, most of them are multinationals. So, and if you look at Australia, ex the banks, when you start looking CSL, your Complete Medical Bank, your BHPs and Rios and all those guys, they're not really Australian companies. They're global companies, operations in multiple places. And that, I guess what we're looking for is, are there companies that are listed in Europe that are actually quite exposed to the US in terms of their operations, and so you can pick them up more cheaply. And so, yes, that's largely the case in terms of the US being the cleanest dirty shirt, but it doesn't mean that means, okay, I'm only going to look at stocks that are listed in the US. I'm not going to look at stocks listed anywhere else. No. And even still, there are stocks listed in the US that hardly have any operations in the US and have got a lot of their operations overseas. And so, it is important to sort of dig into the fundamentals of the company you're looking at and where it's actually exposed.
And so my last question, Damien, is that there are more and more people saying, well, just buy the index. She'll be right. What's your perspective in terms of buying the index versus the more analytical approach where you're looking for value and picking stocks and all those sorts of things? Because actually the costs sometimes are lower just to buy the index.
Absolutely. And then so it's a question about performance and I guess risks within those. There are, when the indexes do well is when large cap stocks do well. So, and that's this, and we've seen one of those years exactly this last 12 months where large cap stocks went well. And so if you're buying the index, you did really well. Where it'll start is where you start to see differentiation is when that doesn't happen. So we offer both. And so that idea that core asset is either some of our portfolios we're running, or you can just buy the index portfolios. But what we do is we buy all the individual stocks for you. One, to get rid of that extra layer of fees, but secondly, it then lets you customize. If you said, "Yep, give me the index, but I don't want any coal stocks," it's fine. We can knock those out. Or give me the index, but I actually want extra cybersecurity, or I want extra, AI or whatever within it. You can then sort of add just a little bit more of those stocks. So I do think there's. I think they get overplayed. I think some of these index ones, and especially you're going to see a bunch of articles now that'll come out and say, "Hey, you no longer need an active manager because look, all these index funds did great in 2024." And it's not that they did great. It's not so much that they did great relative to active managers, but large cap stocks did really well. And so when large cap stocks do well, most indexes look really. Most of the passive portfolios look really good. And then you see the same stories where I think this will be one of those years where you probably see a bunch of ESG ones as well, where it's like, hey, ESG portfolios, you can not only do they outperform the index, but they're also ethically minded and all that. Isn't that great? And it's like, well, mostly that's just what did the energy sector do? If the energy sector had a bad year, then most of these ESG funds don't have energy, and so they outperform, and then vice versa in the years where energy does well, they underperform. And so I think you can try and read too much into those, into the 1 year performance of whether one of them outperformed or underperformed versus others. But I mean, typically you would pay within our portfolios, you pay about 0.3 to 0.4% more to get active investment rather than passive. That's probably, we're probably a little bit lower. Like, so there's a lot of other ones that you might pay 1 or 2% more. And I think once you're starting to pay that 1 or 2% more, that's starting to get to quite hard for managers to make that much outperformance on a consistent basis over a long period of time. And the other thing you do find, well, when you dig into those studies, and they basically go, I know there's one, Spiva in particular, that keeps coming out. There's an S&P one that keeps coming out and saying, hey, active managers are hopeless. You should be invested in passive managers. And you sort of, you look, my big picture of looking at the market, though, is saying, okay, somebody's got to be outperforming for everyone that's underperforming. And Spiva seems to be saying that, well, retail investors are underperforming and active managers are underperforming. And so the only ones outperforming are index managers. And like, well, index managers are by definition the average minus their fee. Who's this magical person who's making all the other end? But I think when you dig in closer, in my view, what you're getting is, active managers tend to make more money than the passive over the longer term. Retail investors end up losing over the longer term. It's about 2%, and most of it's bad timing in terms of buying too much at the top and selling at the bottom. But the problem with active managers is they then extract most of those benefits in fees. And so if you're getting, they might do 1% better, but if they're charging 1%, then actually you end up back at zero. So it's that big question about what really paying attention to how much the fees are within those products, because active managers they're good at making sure that their own nests are feathered, and that they'll they get paid for the outperformance they're doing. And so you just want to make sure that they're not taking all those gains.
Absolutely. Well, Damien, I want to say thank you very much for sharing your thoughts tonight on New Year's Eve. And I want to wish you very, very good wishes for 2025, and of course also all the viewers watching this as well. And we really appreciate your insights. They are really, really helpful, I think, for people trying to work out what to do. And just to underscore, of course, that the World Funds and Nucleus Wealth, that those facilities and tools are available for people. There's links and things you can follow through on. And once again, to underscore that the World and Nucleus Wealth proposition is transparency, openness, and the ability to do lots of different things. And you've highlighted the flexibility in your platforms, and the transparency, which is one of the things that I think is really important. And I always come back to underscore that, because there are wealth managers and fund managers out there who obfuscate a lot of what's going on, and you never quite know what you're getting, what you're paying for, and you have less control with the platforms that you offer. It's much more control, and worth, I think, people considering.
Absolutely, yeah. Appreciate your support, Martin. And the open invitation for anyone to look us up and register your email, and we'll send you more about it. Or register, jump on for a phone call, and we have some advisors who are more than happy to have a chat with you and see what's right for you.
Terrific, Damien. We'll have a great New Year's Eve celebration. I know you're looking over the Melbourne skyline there, so enjoy that. And I'll look forward to seeing you again in a month's time at the end of January, and we'll try and figure out what's going on once Trump is in place. So thank you very much. Have a great evening.
Will be an interesting month. Thanks, man.
Will. Take care. Bye-bye. There you go, folks. Hope you enjoyed that. And Damien's always great value with his observations on the marketplace. Just to say that next week, Adam Stokes is on. We're going to talk specifically around Bitcoin and crypto and where that's heading. So that'll be an interesting conversation. Adam, of course, is a Bitcoin supporter, and we'll be offering some thoughts there, and I'll be throwing some questions at him. So that should be worth a visit. There'll be more recorded shows over the next week in the meantime. And last visit to the dogs, they are still here. They haven't moved, but they're ready for lunch now. So that'll be the next little target on my agenda. So I want to say thank you very much for watching the show tonight. And for those watching in replay, I hope you had a good New Year's Eve celebration. For those watching tonight, enjoy your New Year's Eve celebration. May 2025 bring you everything that you want and desire. And let's hope we have a peaceful, more prosperous world rather than a more destroyed world, which is, I fear, partly on the horizon, but hopefully it can be avoided. So I wish season's greetings and best wishes for 2025. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Take care.